Jeff. Well, thank you for coming back. If you're here first time, thank you so much. Number one, I want to say thank you for giving your time. That's the most precious thing that you have during the day, especially as a busy business owner. So I'm really excited here today as well too, because we're talking about one of my favorite topics. Last week was the introduction to Profit First. Eric Johnson is going to take it home today, give you some real life examples and give you some real life things of where's the money going and all of that. So I'm excited for today's presentation. I actually couldn't be here last week. I was out speaking, so I'm really excited to be here again. Was anyone here the first week? Maybe put in the chat. Were you here one of the first 2 weeks? Have you returned? Someone, oh, Tim raised his hand. Cool. You could either raise your hand, put it in the chat. If you have, I just want to say thank you so much. This is awesome that we have a lot of repeating people coming on here. I've also had calls with people that have watched the recordings as well too. So if you're watching this later on, thank you so much for taking the time afterwards, because I know it's right in the middle of the day. So we're very appreciative of you being able to take some time and learn. We want to teach you. I'm really excited what Eric has to speak on today. Here's the quick overview of what he's going to teach on: deal evaluation metrics specific to Profit First. So we gave you the foundation. Eric's going to take it a little bit deeper. Cost analysis framework, like fixed versus some variable costs, project cost tracking, deal specific allocations, and like where you should transfer things when a deal closes, what an allocation looks like. Scenarios too of how Profit First can help you in the business. So these are some of the things like that we're going to go over today at a high level. Eric's going to help us. Eric Johnson, he's a part of Simple CFO. He's been with us. Eric, has it been? It's got to be over maybe 1, 2 years now. Somewhere.
More than two, less than three, I believe.
Okay, I was going to say, yeah, you've been with us quite a while. So I'm super appreciative to Eric. He is one of the top CFOs on our team. He is one of those CFOs that you get in there and he does care. He cares about you, the person on the other end of the screen. This is not just like, let's get through this. So I know that'll come through today. He's helped a lot of clients over the last few years with us. And he bought his first rental property when he was 24. He's wholesaled a couple deals. He started note investing last year, bought his first note. He's also helped dozens of real estate investors with the Profit First and with all this stuff that we're talking about today. And just getting that financial clarity, the maximizing that profit, making sure you know where the money's going. That's what Profit First is all about, making sure you're paid, making sure that you can actually pay yourself. And then I just want to give you this overview that what Eric is a part of and what we have here at Simple CFO. Simple CFO combined with our CFOs, we own over 1,800 units combined now in the real estate space. We've done over 900 real estate transaction like deals, whether flips or wholesale, that type of thing. And then over 45 years of experience and over 220 companies individually that just the CFOs that are teaching have trained. Now we've worked with hundreds more companies as well and implemented Profit First. But that's just where we want to help you. This is a group of people that we want to make sure you know where your money's going. Eric cares, and that's going to show through today. And I just want to also let you know too, if you jump off before Q&A, we're going to actually turn on the cameras for Q&A. You'll be able to interact a little bit more than just the chat. If you want to stick around for that, Eric will lead that. I'll transition there at the end, getting into the Q&A. I'll be here as well. A couple of other of our team members are here too. If you also too, I just want to say this up front in case you can't stay the entire time and you're like, oh my gosh, I can't stay. How do I get connected to Simple CFO? You can go to simplecfo.com/HV and book a call. I'm actually taking the calls for the next week, so you can talk with me one-on-one if you want to see if we can help you. But I just want to give that out there as well in case you're not able to stay until the end. We've had some people ask in the last couple meetings, so I want to make sure to get that out there. Eric, thank you so much. I really appreciate you. Eric also, he substitutes teaching for me. We want run one of the trainings in SST for Profit First, and Eric has graciously filled in for me several times. And Eric, I'm super excited that you're here, that you're helping, you want to help people, and I'm going to hand it over to you, and I will turn my camera off as well. So thank you, Eric.
Thank you for that gracious introduction, David. And also thank you for the wonderful company you've built. It's a pleasure to work with clients and to serve them and to be a part of their success stories. At this time, I will get ready to share my screen and I will get on with the presentation. We're going to share. Someone please say something when you can see my screen.
I can see your screen. You are good to go.
Thank you very much. All right. So my name is Eric Johnson. It is an honor to present week 3's topic for today, which is real estate deal analysis and profit allocation. And we're going to spend some time looking at how Profit First actually works with real estate investing. As you can see in the corner of the book here, written by David Richter, you just heard from him, it lays out the whole thing. I'm just going to give you a little bit more meat and some real life examples on how those things work. Before we get into this presentation, I do have to make some disclaimers. This is not tax or legal advice. I am going to share a lot of good information that's going to be very helpful for you, but everyone have their own unique situations. Some things that I will talk about will impact some investors more than others. So before you just blindly take my word at anything, vet it for yourself and just make sure that you're taking the parts that's relevant to you. So with that, it is advised that you get good counsel before you make these moves. And also there will be a Q&A session in the end. So just keep notes of your questions, maybe put them in the chat, but in the end, we will address your questions. I know you had an intro to Profit First. I would like to talk about it again briefly for those of you who may not have attended last week's session. Also, I like to go through this briefly because just in case I use terminology that may not be identical to what another presenter may have approached a particular topic, but either way, everything that all the presenters talk about is uniform. So what is Profit First? Profit First is a cash flow management system. If you try to make Profit First align perfectly with accounting, you're going to find yourself really confused. This system is developed to be a simplified system so that everyday business owners can manage their cash flow better. One of the things that we love about Profit First is that it prioritizes the profit. If you see the bottom of the screen, sales minus profit equals expenses, basically what this says is after the money comes in from our sales, we're going to set aside our profit first. It's in the name, right? And then we're going to pay our expenses with what's left over. There's a lot of cool behavioral psychology built into Profit First, which makes this formula work. Because if we can put a container around how much you spend, that alone will help you to be more profitable and keep your expenses in check. Because oftentimes as we make more money, it's natural for us to spend more money. This system helps us to stop that. This system puts financial guardrails around your cash and how you treat it. Here is an illustration of what the accounts may look like. Now, these accounts that are up here, I consider to be the core accounts, but some of these will change based on how your business is set up and how you do things. But for the purpose of this presentation and you being able to keep up with the presentation, I do want to highlight a few things. The red boxes are the accounts that we will call the PTR accounts. PTR stands for pass-through revenue. You're going to hear that phrase a lot. Pass-through revenue is going to be all of the transactions that are directly related to the deals that you're working. All right. So we're going to segregate all of those transactions into this section. Okay. The green boxes are the accounts that benefit you, the business owner. The profit account will be yours for allocations every quarter, or if you have bad debt, it'll be used to pay that down. The owner's comp account is where you're gonna use this to support your monthly lifestyle. So you take the money from here, move it into your personal bank account, and from there pay your mortgage, your rent, utilities, groceries, daycare, date night, that kind of thing. And the tax account is going to be for your federal and state income taxes. This is not for property taxes. It's not for employment taxes or any other kind of tax. This is for the IRS and for your state taxing entity. A lot of people don't believe that this account is for the business owner, but for most of you guys, your tax liability is going to show up on your personal tax return and not your business returns. And for that purpose, all three of these accounts are considered accounts that benefit you. The OPEX account is the one that benefits the business, okay? This is going to be your regular expenses. We're going to go much deeper into this on this call, but at this point, I just want you to know the basic separations that we're going to talk about. PTR accounts are going to handle all of the deal transactions. The profit owners company tax accounts are going to be for your benefit. And the OPEX account is going to be for running your business. So the key points from this brief review that I want you to just kind of lock in your mind is, actually, I didn't talk about something. Let me go back really quickly. So with the income account, once you have a closing and you get proceeds from that closing, the money will come into the income account. The first thing you're going to do is identify all of the PTR type expenses that have not been settled in that deal, and you're going to immediately move them out of the income account into the appropriate PTR account. What's left over is called real revenue, and this is what you're going to allocate based on percentages to the accounts below. So the key points to remember is what I just explained, the difference between total revenue, or that raw number that comes in before you send the PTR funds to the appropriate places. The real revenue is where you're going to do your allocations from. You want to do all of the deal transactions in those PTR accounts. The operational account is going to handle all of the business expenses like your accounting, your marketing, the software, those kind of things. And it's really important to use each account for the purpose that it's set up for, because if you don't, you've basically created a big shell game for yourself that will only confuse you. But if you use it correctly, it'll be a game changer for you. Right now, we're going to talk about variable costs versus fixed costs. On this screen, we have a scenario, and in this scenario, we have two scenarios actually, but the thing that both of these scenarios have in common is this. The investor in this setup here has a goal to have $40,000 in profit after the deal is done. All right. Now, when it comes to actually transacting or doing that deal, we have two scenarios. In scenario one, the purchase price is $75,000, rehab costs $50,000, hard money loan interest $3,000, other holding costs is $750,000. And what we see down here is a project cost of $128,000. In scenario two, we have a larger purchase price, slightly smaller rehab costs, more interest, more holding costs, and higher ARV, but its project cost is $231,000. These costs are variable because they can change a lot, but in these scenarios, this investor still landed on their goal profit per flip, which was $40,000. Another thing I would like to highlight about variable expenses is this. If you have no deals, you have none of these costs. If you have a lot of deals, you're going to have a bunch of these costs. And so that variation is what I wanted to highlight. And by the way, all of those expenses that I just showed you will be handled in these PTR accounts. Everything from acquisition to disposition for the deal. It all happens right here. Okay. Next, we'll talk about fixed costs. These are the costs that the business will have to pay regardless of the number of deals you do. In this scenario, this is a mock budget that I built out just for illustration purposes. I won't read all of these numbers out to you one by one because I'm sure you all can understand it perfectly. But the point that I want to highlight here is this. These expenses here are what we can actually budget on each and every month. We can track to make sure they don't go overboard. We can control these much more. But like I said earlier, these expenses will be necessary even if there are no deals, making them fixed. And just for a little more point of clarity, even though we're using the term fixed expenses, there will be some fluctuation in these, especially when it comes to marketing. Marketing can kind of go up and down depending on how you structure things, but we still have a lot more control over these expenses than what we have over the variable expenses that I showed you in the previous slides. And all the expenses I just showed you get handled in this bucket down here, OPEX. So now we're going to shift gears a little bit and we're going to talk about project cost tracking. I'm sure you guys are doing this, but it is highly recommended that before you start any deal that you do a pre-deal analysis as thorough as you can. And once you get that analysis done, you want to track your performance based on that analysis as you are conducting that deal. Here are some of the things that you need to be tracking when you are controlling your project costs. Of course, you'll know the purchase price, and you also want to track the closing costs. Right here, I put A to B. When I put A to B and B to C, this basically is, the front end transaction versus the back end transaction. You, the investor, will always be B. So in this scenario, you're purchasing, and so you want to make sure you track the purchase price and the closing costs. You want to track your rehab expenses, your labor and materials, permits, anything that's needed in that respect that's needed to get the house in a saleable condition. Financing is huge when it comes to real estate, and so most flippers will use hard money loans or private money. You want to track that loan interest and the points that needs to be paid on that loan. Same thing with your holding costs. You want to make sure that you are accounting for these. But with the loan interest and the holding costs, one of the major things that we want to keep track of is the amount of time needed in that deal, because the longer you're in that deal, the higher the interest and the holding costs will be. So it's important to also track time. And then on the B2C side of the transaction, you want to calculate those holding costs. Now, those costs may not come out of pocket from you, but it's still important to know and track it because they will be deducted from the proceeds that you get at closing, which impacts your profit directly. A lot of investors incentivize their team by giving out commissions. And so if you have commissions, you want to track those. This last bullet point is something that we're going to talk about in much greater detail towards the end of this presentation, but you need to track how much of your funds you put into a deal, whether that's from cash that you have, whether it's from credit cards, or from lines of credit that you're able to use. Some other tips and things to consider when it comes to project costing is as follows. If you use the PTR accounts correctly, it will give you a lot of visibility into your business. When I'm working with clients and I am working with their bookkeeper, I tell them that every transaction that happens in those PTR accounts needs to have an address tagged to it. And if that can happen, not only will your books give you a holistic view of your business's financial performance, but now you can look at your business at the deal level to see which deals and which types of deals are profitable and which ones aren't, without having to manually go back and try to figure it out. So using those PTR accounts correctly will do wonders also for your books and the kind of financial data that we can extract by doing this. In the pre-deal analysis, it is highly recommended that you put 5 to 10% buffers in certain areas. For example, rehab budgets go over budget all the time. It's smart to just add a 10% buffer to your rehab budget before you even start. The sales price, oftentimes, not oftentimes, but many times, the investor is not able to sell the property at the ARV that they were hoping to sell it for. So we tend to subtract a couple of percentage points on that end. And we also like to add an extra month or two in deal time. And if the deal is profitable based on these metrics, you will have a lot more confidence that you can get into that deal. It doesn't have to go perfectly, but yet you can still exit profitably. Now, if you don't add these in and a thing or two goes south, the deal could end up being unprofitable and you don't want that. So consider adding those buffers into your pre-deal analysis if you haven't been doing that already. And you want to track the amount of cash you put into the deal. I spoke on this earlier. We're going to speak on it even more towards the end, but it is going to be vital that you track this, because this one issue is the one thing that ends up causing a lot of investors to max out their credit cards, max out their lines of credit, and end up in a cash flow crunch. And that is exactly what we want to avoid. So right now, we are going to talk about some deal-specific allocations. I have some numbers here, and we're going to work through this together. I'm going to ask you to trust me on the math, but more than that, I want you to understand the concept behind how we're going to treat the finances and the allocations here, okay? So in this scenario, we have a purchase price of $200,000. We have a rehab budget of $25,000. We have hard money loan interest throughout the length of this deal projected to be $8,700. Other holding costs will be $1,000. The total project cost based on these numbers is going to be $234,700. For disposition costs, I just simply put 5% to the sales price to end up with this number. For this scenario, we will assume that maybe there's a real estate agent commission and a lot of other miscellaneous things included there. All right. And the ARV is going to be $290,000. For the financing on this deal, the hard money lender agreed to lend the investor 75% of the ARV. So 75% of this number here is $217,500. They're charging a 12% interest rate, no points. So that makes their monthly interest $2,175. They plan to be in this deal for 4 months. That's how we get the total interest of $8,700. Before we get into how the money flows, there is one step that most people make. Well, they don't make this mistake after working with us, but they often make this mistake before working with us. Calculate how much of your money will be needed to make this deal go all the way through. So the numbers here play out like this. The project cost is $234,700, but only $217,500 was financed. And so this gap will need to come out of pocket from you or from some other funding source. Also, we have hard money loan interest of $8,700. And so by doing this in advance, we know that before we can start this deal, we need access to at least a little under $26,000. Very important step. And so the deal proceeds will play out this way. He sells the house at the targeted price, $290,000. The loan gets repaid. Right here, the closing cost of $14,000 is also factored in. And so gross proceeds from this deal ends up being $58,000. Most times when an investor closes, they treat this number as the amount that they would allocate if they were doing profit first. But there's a very special consideration that we have to look at before we start doing allocations. Right now, this is your total revenue, what you get back from closing. Out-of-pocket costs. The money that you put into a deal needs to be accounted for, and it should be treated with just as much caution as you would for an outside lender. So when that deal closes, the first thing you do is put that money right back into your reserves or right back on your credit card or right back into your line of credit. This is the scenario that most of my investors find themselves in when they come to us. They have a lot of deals that are in play. They have a lot of credit cards, they have a line of credit, but all of them are maxed out and they don't know why. This one step is the reason why. All right, I hope you guys are catching this. So after you put this money back, now you have your real revenue that you can actually allocate, and it turns out to be $32,100. Let's say this guy's goal was to profit at least $40,000 per flip. Initially, he thinks he met this goal. In fact, he exceeded it. But the truth is, once you factor in the amount of money that you had to put into the deal, you did not meet that goal. Another way to say that is this: oftentimes your deals may not be as profitable as you think they are, but this process flushes that out. And so here's what this example looks like if we're actually doing allocations. So the total revenue was $58,000. The PTR expenses on this was 25,900. This is what was paid out of pocket. All right. So that leaves the revenue, the real revenue of $32,100. Now these percentages that you see over here to the right, these are the TAPs, or the target allocation percentages, for businesses that are generating between $250,000 and $500,000 in revenue annually. Now, most likely you will not start at the TAPs. You will start at what we call CAPs, your current allocation percentages. Those percentages will be dialed in for you when you get a profit first assessment. But for the sake of running this example for you to see, we're going to use the targets. So 10% of this real revenue gets transferred to the profit account. 35% of the real revenue gets transferred to the owner's pay account. 15% goes to the tax account. 40% goes to OPEX. And this is what that breakout looks like right here, okay? Here's another scenario that is similar. The only difference in this scenario is this: instead of working with a hard money lender who may have sent his money straight to the title company, this scenario is going to imitate you raising the money and you have it and you're bringing it to the closing yourself to transact the deal. So in this case, since the loan isn't repaid at closing, it comes straight to you. So the very first thing we do when revenue comes into the account is to move out all the PTR. We're going to repay that loan immediately. And we're also going to repay ourselves what we put into the deal. And we still net back at the same real revenue of $32,100, the amount that we're going to allocate. These percentages are the same, the real revenue are the same, so these numbers are all the same. The point that I want us to highlight in this is if you have any debt that has not been paid off when you receive your gross proceeds, pay that off before you allocate anything, okay? One of the topics that I like to go over with clients is knowing how many deals to take on at one time. Earlier, I showed you a diagram of the profit first chart, and I had a reserves PTR account there. When I put reserves in that setup, what I'm referring to is money that you have that you're going to put into a deal. All right. So you can use this reserve account to pace how many deals you can do. Let's say on average, you need $30,000 to complete a deal. So if your reserve account has $30,000 in it, then that means you can only do one deal. And you can't do another deal until that current deal closes and you put that $30,000 right back. If you want to do 2 deals a month, you need $60,000. I'm not going to take you through that math because it's pretty simple. I'm sure you get it. But this is very important. And I highlight this because I'm actually dealing with the client right now who have 7 deals that they're working on. All of their credit cards are maxed out and they have no more they can pull from their lines of credit. And we are actively looking to raise more money just to get them through. But if you know this in advance, you can avoid an unnecessary cash flow crunch. And by the way, it doesn't have to be a reserve account with your cash in it for the reserves. It could also be credit cards and lines of credit. And so in this case, if we're using those for your reserves, then you want to always track your available credit. You need at least $30,000 in available credit to do one deal if you typically need this amount of money to complete a deal, so forth and so on. Now, if you find a good deal and you don't have cash and you don't have any more available credit, wholesale the deal. Otherwise, you're going to put yourself in a situation where you're going to have to chase and hunt down money just to finish what you started. And that is not a fun place to be, because oftentimes those deals can become more expensive because then you have to hold on to it longer, which means more holding costs and more interest. So keep very close track on your reserves or how much available credit that you have so that you can know if you can complete a deal before you even get into it. And if you know you don't have it, just wholesale it, which is a great way to get cash in quickly. I did not talk about wholesaling at all during this presentation. I kind of figured if you can follow during the, if you could follow during the with the flip example, then the wholesale example will be super, super simple. And so just to briefly go through this, let's say the goal was to get $10,000 per wholesale deal. All right. And he met the mark, $10,000, he gets that closing. If he gave any, or she, if they gave any earnest money deposit from their own funds, especially, they want to put that back into the appropriate PTR account. Also, if they pay commission based on percentage of what closes, you want to pay that out or move that into the PTR account as well. And you will end up allocating, you will end up allocating $7,000, even though $10,000 came in. So again, total revenue, $10,000. The PTR expenses total up to $3,000. You end up allocating $7,000. And this is what the allocation separation looks like after everything is settled based on the percentages that we have here. So I must admit, I think I sped through my presentation way too fast. I am almost at the end, but I hope you have some good questions that's waiting for us. Here are some of the ways that Profit First can help positively affect your business. And I hope the examples that I gave clear examples on how you know if you're it'll get you clear on your profit per deal. For example, if you get proceeds from a closing and you remove all the PTR expenses back to their respective accounts and pay those out, if there's nothing left to allocate, that means that deal was not profitable, okay? However, if once you clear out the PTR expenses, what's left over for real revenue, you know that deal was profitable. And you know that even if your books aren't done yet, because the way we move our money just makes that completely obvious. You can't miss it. The process we use also keeps deal-related debt in check. We spoke about this quite a bit. If you use credit cards or lines of credit for a deal, once that deal closes, put that money right back so that way it become available for the next deal that comes. Or if you have any debt that's not cleared or paid off, once the deal closes, pay that off first and then allocate. All of that keeps your debt in check and keeps it from running away from you. I also have this thing about an unintentional Ponzi scheme. When I bring up this topic, it is mainly related to when investors have to use proceeds or loan money from one deal and put it into another deal. We want to avoid that at all costs. By honoring the system that we're sharing with you today, it'll help you to not do that, okay? We talked about how to pace your deals and how many deals that you can do at one time. Look at your available credit or your reserves. You need to have a clear picture on how much on average it takes you to complete a deal that you need out of your pocket, and only enter into a flip if you have the money to see that deal through. Otherwise, you're going to cause a cash flow crunch for yourself and maybe make that deal a little less profitable because you're going to hold on to it longer because you don't have the cash to move on it the right way. And you want to know your monthly operational need. All of these are going to be in your OPEX account. Those accounts are going to be more fixed. You can budget on those, and it'll just help you to know how much money within your entire business ecosystem is available just for keeping the business itself going outside of the deals. Very important distinctions. If you do these things, it will just bring so much clarity into your business and into your numbers. Real estate finances are anything but simple. Anything that can make it more simple is encouraged, which is why we encourage what we are preaching to you today. So as we wrap this up, we at Simple CFO will help you lay a good foundation for your finances. we do help business owners to organize their numbers, to know what they make, keep, and spend, to help them become more profitable. We help them implement profit first and give you a dashboard so they can be dialed in on the numbers that you need to see so that you can make strategic decisions to help you grow your business. At this time, I will pass the ball to David.
Boom. That was perfect time. Oh, dang. Can you kick my person out? I think I have two people on here and I'm hearing an echo, David. So just heads up. But Eric, thank you so much for allowing for coming on here today and teaching us about this. Honestly, this is great stuff. Like, if you haven't been here the first 2 weeks, I believe we gave the Profit First cheat sheet should have gone out with last week. And then when I taught the first week of how to think like a CEO, it also was a part of that as well too. The Profit First cheat sheet, which also gives you access to my book, the full book, Profit First for Real Estate Investing, which if you want to go deeper, honestly, Eric gave real examples of like today and what's happening. And the book, if you want, has some more examples too. Like if you need to go deeper, if you like the numbers, if some people are on here, I don't want to call you out because I know you guys are engineers and I know some of you are, like, because we work with you. So if you like the numbers and you like going deep and wanted to do the analysis, you can pick up the book as well. We'll make sure that if you didn't get that you get that. And then here too, if you need help and hand holding, that's what we're here for. Then you get to work with someone like Eric who has a ton of experience and then who's watching this for you so you can go do deals. You need to do deals. You need to get the money in the door. It's not profit minus sales equals expenses. It's sales minus profit equals expenses. I make a sale, I pay myself and make sure the business is healthy first, and then the expenses are there to grow the business, but you have to have sales. But a lot of people let the finances weigh them down and they don't get good help like this if they need it. And if you're like, there's no way, I don't need a CFO, like that's an ivory tower when I'm doing $10 million. It's a fractional. We have two different programs where you can come up and just get the implementation, or if you need hand holding ongoing, we've got that as well too. You just have to be making something. If you're not making anything right now and you haven't done your first deal, I get the question a ton, like, when should I start Profit First? Start it now. You need good habits with your money. If you don't have good habits wherever you are in your personal life, a W-2, or you've been in home investors and you've been real estate investing, but you don't know where the money's going, build some good habits now. That's where the book comes into play. If you want to call with me, because I'm taking the calls for the next week as well myself. I want to be there for you, specifically for this group. I don't offer that a lot, but this is where right now doing that. If you want to have that conversation, I'd love to talk to you, at least just to see where are you in your business. Can we help? If not, can I ping you to someone in my network that's really good as well too? So if we can help you there, honestly, there's a couple things too that while you were talking, Eric, that I wrote down myself. That rehab budget, you made one remark that I think is so relevant to all of us here, is that we usually go over budget, right? Like that's just known in the real estate investing space. If you're not doing new builds and you're not like a professional contractor, like a lot of us either don't estimate it or the contractors don't give us the right, whatever it might be, or a contractor walks out on you on a job and then you have to do something over again. Like those things happen in our space, and it's making sure you have a good structure. Like Eric was talking about today, he went into more the nitty gritty, and I love this because like this is the meat and potatoes. This is where we want you to know, like, if you have these accounts, it can protect you from running out of money at the most crucial parts of your business. It's not just about the money that you're making that's coming in, or even if you're doing a lot of deals. If you don't know my background or haven't heard me speak before, we were doing 25 deals a month in the real estate space, wholesales, flips, all the things, rentals, but we were spending 26 worth because we didn't have clarity. This was 10 years ago. And I'm like, if we would have had what Eric just talked about today, there's no way we would have been in the same financial position at the end of that company versus like when we started. And like, this is why I'm so thankful to Eric and our team, like putting all this training together and coming on here, because so many people scale themselves out of business because they don't have some of the foundational pieces, and we're giving this to you. We want to make sure that you get it implemented. If you need the hand holding, that's what we're here for, is to be able to hold your hand. And if you walked away from last week and this week with a little bit of overwhelm, start one place. Start with setting up one account, maybe, like the profit account or the owner's comp or something like that, that helps you keep more of the money you're making. I spoke at the end of 2023 to all home investors breakout room at the December convention. Someone heard me speak on that, just the one account. Then they came back to me. This was so cool. In December of this last year, so what, 4 or 5 months ago, in December convention, can't believe it's already been 4 or 5 months. December convention, and came up to me and said, you know what, David, I opened up one account. I've started putting a little percentage in there. He's like, I've never had business reserves. I've always had the one big black hole bank account where money comes in, money goes out. I don't know where it's going. And he said, I did that for a year. He's like, I actually have 6 months of reserves in that one account now, and I've never had reserves in my life before. And I'm like, this is why. This is why Eric's here. This is why our team's here. Like, we want you as a real estate investor to have that peace of mind. When he told me that, it lit me up again, where I'm just like, just do one thing. Like, if you're overwhelmed, start somewhere. Start with a good habit. That's what a wealthy business owner does. Money comes in and not everything goes out the door right away. That's why it doesn't matter how many deals you do. You have to be doing deals, but it's not about the volume until you can control the cash flow, until you can control what you're keeping. Making it is a skill, keeping is a discipline. If you need that help and if you need that discipline, that's where this comes into play, like the profit first system. If you need someone to help you as well too here. But I wanted to also say too, the pacing your deals, what you talked about, Eric, that is a huge thing. Everyone just grabs every opportunity, but sometimes they're not ready for the new opportunity because they haven't really buttoned down the last one. It's like being able to do that and being able to project, to be able to know what cash you have to work with. So Eric, I just want to say thank you again. I love this presentation. I'm going to take you everywhere now because it's like a two punch. Like, we got to get it set up, but then that was a great explanation of the back end of like how Profit First can really help you in the different areas. We're going to transition into Q&A now, where if you have a question for Eric or our team, we're going to be here to be able to answer those questions. If you want to book a call, that's what this screen is all about. And if you want to get on a call with me just to see if we can help you, if you want to stop living the rat race out and want to get some of that financial freedom, financial peace in place, then I want to see, I think we actually have one question that hasn't been answered yet. The understand correctly that PTR, the deal's contribution to costs that aren't specific to the property. We'll start there. Eric, I'll probably let you take that one and run with it. And then I think David is going to let people as well, if you want to like raise your hand or put your question in the chat. We'll just go through until people don't have questions. But this is what we're going to do here and land the plane with the Q&A. So Eric, do you want to take this first one from Kathy McKenzie?
Sure thing. And so Kathy, PTR, pass-through revenue, these are going to be expenses that are going to be deal specific. These are going to be funds that come in that's not for the benefit of you, and it's not for the benefit of the business. It's strictly for that deal. And if we keep those PTR expenses segregated into those accounts, it just opens up a lot more clarity for us, because it's always going to be important to separate your operational budget from the set of funds you use to transact your deals with.
Especially if you're using like an investor vault. Like if you're using a vault that has money that has come in from other people that you're just using for the rehab project, to know how much money do I have to finish my rehabs, and then all these other accounts over here like the profit, the owner's comp, the OPEX, all that stuff. It's like, what do I have to run my business? Those PTR accounts are like really to know, okay, before I get the deal done, can I get the deal done? Do I have enough of the investor's money to finish it out, or do I need to borrow from my own business? It's like you get to treat yourself almost like a private lender at that point, where in the past you might have just taken your own money and put it towards a deal before, and then you never think about paying yourself back. I love what you said, Eric. Like when a deal comes in, the first money needs to go back. Like, do we need to either pay back that lender? Do we need to pay back ourselves? Like if we borrow money from ourselves, like making sure that even if it's you, even if it's you that you took your money from OpEx, like putting some back, but maybe giving yourself some interest too. Like, what would you give a private lender? It's like being there to be able to use your own money, but then tracking it on a better basis as well too, and treating your money as important. If you're going to treat the investor vault and the other investors' money as gold and making sure you're doing right by them, make sure you're doing right by yourself too. Don't just, I don't just want it over here. It should be over here 100% with the investors, but it should also be for yourself, like protect your money as well too. Cool. Any other questions? I want to make sure you can put it in the Q&A or the chat. You can raise your hand. You can do the hokey pokey, anything to get our attention. Any other questions? Eric, maybe we can stop sharing the screen and then we can
stop
see.
sharing. Someone asked to see the percentages. I'm not sure if one of our team members have the caps chart handy, but I'm happy to explain it if someone can find that.
Let me see. I might have it for home investors specifically because I built one specifically when I did the book, the extra chapter. There's an extra chapter. If you get the download the Profit First cheat sheet, there's actually an extra chapter I wrote for home investors specifically that has home investor specific percentages based on the size of your business. What are the targets? And I just want to make sure that I can find that one because I'm pretty sure I have that in here.
I actually have so much more to do than I thought today.
Some have a lot more to do than Ryan Chen. Ryan, we can hear you. Good to hear you, buddy.
With Nate, I have planned.
But as you pull that up, I do see a question I can probably answer pretty quickly. Eric Villanueva asks, are PRT accounts, are COG accounts? Yes and no, but mostly yes. So in Profit First, like the traditional Profit First book, they make it a point to say that COGS and mats and subs aren't exactly the same, but they're so close, you might as well consider those to be cost of goods sold. Typically, when we help clients set up books, at the revenue line, you see the gross proceeds. Then after that, you see all of the deal expenses in the cost of goods sold section, and then the gross profit line gives you your actual profit per that deal. And so for the purposes of what we discussed today, it's safe to say that PTR accounts, those expenses, if used the right way, will end up in the cost of goods sold section.
Can you see my screen? I was having issues with Teams last week and sharing. So can you see the taps for home investors specifically?
I can't see it just yet, David.
Unshare, David, and try it again. Sometimes it picks it back up. So try it again, please.
I'll try one more time, but I was having issues last week too, so I'm not sure if you can see it or not. If not, what I'm going to do is I'll share it with Bailey inside of our thing. See if she can, if you can give Bailey or get this. Oh, Eric, you'll probably have access to it too. It's in our real estate education series inside of Slack.
Okay,
if you want
right now,
you can share it. And I don't know, I'm gonna have to throw away my computer, get a new one if Teams isn't gonna work. So I'm just not sure why it's not sharing. But yeah, if you want to pull that up, that's a really good chart. That one has the advertising on it on both if you're buying and selling or if you're buying and holding. So making sure that Eric, looks like you got it now. If you're able to share. Cool. There. Yep. I can see it.
All right. So selling companies, when we speak of selling companies, we're talking about fix and flippers, wholesalers. You're in and out of a deal typically in a year or less. Right? You're not holding on to a long term. You don't get the benefit of depreciation type things that the long term entities will do. And so I will start by going over the categories, the different columns. So column A is going to be for revenue ranges 0 to a quarter million. Column B is going to be from a $250,000 to $500,000, and you can see how that goes up the chain, right? Your allocations are going to be based on real revenue, not gross proceeds. So we need to know that real revenue number or the actual profit gain that you typically get from your activity. And these percentages down here, we call these TAPs, the target allocation percentages. This is where we want you to end up. This is not your starting point. The typical starting point is going to be you meet with someone like us, we do an assessment and see your historical spending. And for most people, the OPEX is way higher than one would expect. And and we work on lowering that as we move along. I want to make a quick distinction. On this particular chart, you see OPEX is 5, advertising is 25. These two are both considered OPEX, and so this will really be a 30% on OPEX at this level. I didn't talk about this during the presentation, but when it comes to profit first, you have like a setup that you can do that's core that everyone does, but you can make key accounts as you need them. A lot of people spend a lot of money on marketing, so we often will also make a marketing account, but that marketing account should be considered a subset of the OPEX account. And sometimes we do the same thing for payroll. And so when you see these two boxes, combine these percentages for your OPEX percentage, okay? When your revenue is lower, you're going to pay your profit's going to start at 5. You're going to pay yourself more. Taxes is always going to stay at 15%, but your OPEX percentage is going to be lower. As your business makes more money, you'll notice that your OPEX percentage is going to increase. Your owner's pay is going to decrease, but your profit account is going to increase. All right. And with the profit account, that trend happens until you reach that $1 million mark. There's like this crazy gray area that's hard. That's a bit harder for businesses to grow between 1 million and 10 million. And so that's one of the reasons why we back off the profit allocation a bit, just to give you a bit more juice to make it through that 1 mil to 10 mil period. Then after that, the profit percentages start back to increase. Another question that I will try to preempt in case someone's wondering, why is it that taxes is only 15% when most tax brackets are much higher than 15%? The thing that you should remember is that you're taxed on your net profit, but when we set aside for your taxes, we're basing this based off of real revenue. So since revenue is always going to be higher than net profit after all the spending is done, you don't have to set aside 30, 40, 50% of your revenue just to meet your tax obligation. So this stays the same throughout, and from my experience, is held true. If the clients are able to hold this, they never have to look for money for their taxes. I think I'm kind of rambling now, so I'm going to back off a bit and see if I answered your question correctly, and if there's another question that sparked from anything I just said.
Now I can actually see the chat. I don't know what's going on with my teams and stuff, so this is great because now I can see someone saying, where does the new computer come from? The OPEX account. So there we go. Good. So people can see. If you're using, there are some other questions inside here. So if you are using QBO, are you setting up each account and a bank account? If so, then is your income account gross revenue a bank account? And it should be normally a zero balance account except when you sell a property. Yes. I think the short answer to all of that is yes. Yes and yes, because it's literally that revenue or deposit account is like a holding bucket. I like to call it like a control account. Usually, what most people have is the black hole bank account. As a business owner, money goes in, money gets sucked out into the swirling vortex of doom, never to be seen again. But if you set up the system of profit first and you have all these bank accounts and these are the percentages and these are the types of accounts here that you're setting up, if you have that income / deposit account, now you have an account to see what all is coming in. And that's where Eric was telling you, if you have money that really isn't income, it came from maybe a lender or your friends or family or someone that trusts you to hold their money to be able to use a rehab project, then you would send that to like the investor vault, like a PTR account, that pass-through revenue account, to be like, I'm going to manage my rehab from there. And my income and deposit account, well, if that rest of that in there now is income, then I can transfer that to the rest of the account. So yes, it would be a zero balance, or do what your minimum balance is so they don't shut your account down. Like if you're flipping, and you're doing like one a quarter, like don't have that income account go to zero for a quarter because your bank account might get turned off or whatever, depending on your bank and who you're using, all that type of stuff as well too. So there was the longer answer. The short answer to both those questions is yes. So for revenue, okay, so that's where that came from. I see why you did that now, Eric, because they wanted to see the taps and the targets. Where can we get the book with the extra chapter? Jim, that is in the Profit First cheat sheet that we'll make sure that the Home Investors team has to send to everyone who has signed up and who is registered. If you have that Profit First cheat sheet, I also gave it, I think, at the beginning week as well too, how to think like a CEO. One of it was the Profit First cheat sheet as well. We want to make sure you get that. If you click on the link that has my book, it takes you to the folder where it actually has the extra chapter for Home Investors specifically as well too. It's a folder. It's a Google Drive folder that has it. Think everything else was already either answered or is in there. Do you see anything else, Eric? You might have to see new ones that come in.
David, can you hear me?
Yeah.
Okay, I can't access the chat. It won't let me put anything in it.
Me either.
So, no,
Me
but
either.
it is letting me do Q&A.
Oh, cool. Okay.
So, can I drop a deal, numbers in the Q&A and quickly look at it and tell me, do I have what you're explaining correct?
Cool. Yeah, I think that would be great. And I'll have Eric take that. Guide you, CFO.
All right, I
jump.
put it in Q&A.
Q&A. Let's see if I can find it.
Oh, there. Yep.
Um,
Q&A. She put purchase price, rehab costs, hard money, salary, closing, commissions, total. So sales, ARV, the profit. Profit is 55 and you needed 90K to fund the deal. Was this worth it? That 90K doesn't come back, correct? Well, do you want to take a step? Can you see that, Eric?
yes, I'm making sense of the numbers right now. Let me get a quick second to study these numbers so I don't just blob out an answer trying to sound smart.
Yeah.
Right.
Thinking is a skill. And I like that you're using it.
All right. Profit.
Is it, do you say your name Thea? I want to make sure. How do you say your name?
Thanks. It's the TH is like Thea.
Thea. Okay, awesome. Well, thank you for putting this together. I love live examples with actual hard numbers from someone who's doing a deal. So this is really great.
I think I have a preliminary response, and I'm going to start with first. Can the entire group see the question? It'd be kind of hard to read out because there's a lot of numbers, but I'm going to read the question part at the end. If the profit is 55K and you needed 90K to fund a deal, was it worth it? That 90K to fund the deal, that doesn't come back, correct? I love this question. If you put more money into the deal than you get from closing, then that deal was not profitable. Like maybe all the lenders got paid back, but you weren't able to pay yourself back what you put into it. And so in this scenario, if you get 55K as proceeds, but you had to put in 90,000, assuming everything else at closing, all other debt was settled at closing, you still have to now try to pay yourself back $90,000 out of that 55 just to break even on that deal. So that deal sounds like a loss to me.
Let me ask some more clarifying questions too, Thea. Are you able to come off mute? I just want to make sure we can have.
I'm here.
Okay, cool. So you had a 565 purchase price, 120K in rehab costs. When you say you needed 90K to fund the deal, did you get that 90K from your own bank accounts or did you get that from a lender?
Hard money.
So that was.
Yeah, and when I'm calculating 90K on is that you've got and maybe it's actually more than that, is 45K in hard money because that's how much it's gonna in holding, right? The 6-7 months that it may take to project. And then you need to close the deal, which is 20K. And then the salary is 45. That's me paying myself operational costs over the 7 months that I need to do this project. So that's where I was getting 90 is the hard money
Oh,
and the salary. And I wasn't
okay.
even calculating the closing. So I might not quite be understanding how those
Okay.
numbers all.
I understand now. I think I can help with the entire, I think I can help with the entire thing here. What you just put into this deal, the numbers, was some fixed costs that to run the business and some deal specific costs that you put in there. Because like the 45K salary, was that just money you took from this deal, or was that like from just the business? That's what you would have paid yourself over those 7 months or whatever anyway. Is that what, that's what I'm understanding that 45K to be?
Yeah, like in order for me to exist, I need to like have a certain amount of overhead covering my expenses,
Okay. So
right?
and the money associated with this deal specifically, though, is the rehab cost, the hard money, the closing, and the commissions. So the
Right,
total 800, the sales ARV was 90, the profit was 55. So it sounds like when you paid yourself, when you got the 55K check, you were already able to pay back the hard money. You were already able to pay off all the closing costs and everything with that because the sell price was like 900, and then after everything the dust settles, you're left with 55K. And that's even after paying yourself, like you even put some fixed costs for your the overarching business in there as well too. So now you're left with that 55K. Now digging just a little bit deeper, because like Eric's answer was preliminary, which was great. Like I would agree with him 100% if we understood that you had to bring 90K, like to fund the deal, and then you only got 55K. But the 90K that you're talking about there is more like the outside money, but it was all paid off. It sounds like at closing, and 55K was really the profit on this deal. And
right.
to be able to now be able to allocate to those other accounts like profit, the owner's comp, the tax, the OPEX, like that. Here's a couple ways to think like, was this worth it? If you needed to pay yourself 45K salary over those months, because you gave me those numbers there, that 19,250 that went to the owner's comp bucket, that's helping to pay for that 45K you took, or for future 45, over the next 7 months. So it's like, how many of these deals do we need to do in order to be able to pay ourselves consistently what I need to be paid? Is it filling up that bucket? So I would ask the question differently now. It's like, it's 55K, great. So is this enough? And how many deals am I doing? And can I pay myself what I need to? Can I put the money where it needs to go? Do I like this amount of profit? Then there's another question you could ask yourself too, just overarching, is the sales ARV was about 900 and the profit was 55. Am I okay with this percent of profit as well too, or do I want that to be higher? Like 55 into 900,000. It's like you're seeing what your gross profit margin is on this deal versus like what you were able to sell it for. So that's like, is that enough? Like the higher the property value, usually the bigger spread I want to make, like on gross profit margin, because it's a little riskier, right? A high
Yeah,
end property, luxury or what, even if it's not luxury, a higher end, if it sits there longer, has a lot more closing costs, has a lot more holding costs. So am I willing to take that risk for a longer time for that, for 55K over the 7 months that it took to complete this project as well? So you can ask yourself different questions, but I would also circle it back to what's important to you. Did you like this project? Was this something that this is your bread and butter? 55K is normal. Like this helps us to do the deals that we want to do. Do you get what I'm getting at too? It's like I can ask
yeah,
this and like try and say, oh, this would be right. But honestly, you're the only one that could tell me if it's right for you based on what are your end goals? How many projects are you doing? And I can glimpse a little bit into it. Like if you're doing several of these, I would say that you're probably doing well because you can pay yourself what you're needing to pay yourself over amount of time. Like if in one deal we can get almost half that back, like of what you paid yourself. So we just need to do a few deals like this, every few months if you've got a pipeline full of them. And I can just tell just from just very general numbers on this one deal, like how many deals you would need to do, like just by getting some of this information. So hopefully that was helpful. I know that was a lot of words, but I needed to clarify and ask some more questions, here just to make sure we were understanding too, to get
Yeah,
deeper in.
no, I appreciate that. I mean, in my personal opinion, the 55K profit isn't enough for this kind of project. I'd like to see that, more like 70, 80. Um,
I would agree.
so yeah,
Can I add a piece? I'm listening as David's talking, and um, that salary piece for $45,000. Let's say if we treated this like the regular way, and that salary was not included in the calculation, but treated like as a part of what would be divvied out when it's time to allocate the real revenue, that would make the profit $100,000. It appears you have the 55,000 profit
oh,
on the end, plus what you already took out for the salary of 45,000. Am I thinking about that the right way, David? So it sounds like
yeah,
that was a $100,000 profit deal, just that you paid yourself 45,000 of it in salary before it actually closed.
yeah,
You could. I would need to see her whole business. That's why, as a CFO, it's hard to pinpoint one deal and say, is this good or not? Well, let me ask you like a dozen more questions to know if it's good, because like how
right.
many deals do in between when you started this deal and finished this deal? Did you wholesale any? Did you have flips already in the pipeline? Did that
Yeah.
contribute to 45? Because if it didn't, well, then yeah, Eric's right. Then it's almost like this deal helped to fund it. Plus you got profit at the end. So that's like a little bit of what I'd be asking as well too. But that's why, as a CFO, like Eric just brought up a great point. You got to be able to ask the right questions of like, what's important? What are you doing? Like, show me your overarching picture. That's where a lot of people have trouble, because we lock into the deal and the deal might not stand on its own. But like when you put it into, well, I did 4 other deals and those helped to create it. Plus we did this deal. It wasn't as much as I wanted to. There was a little bit more cost, but I'm still glad we did this deal. So that's just a couple of the other observations I'd make right there too.
Awesome. Thank you guys so much. What I noticed for myself last year that, because I'm still relatively new, I've been doing this for a while, but I couldn't quite figure out where the money was going, and so I read your book, and then I jumped into this program because I just knew that I needed to listen to this. Anyway, one of the things that hit me in somewhere in the middle of last year when I was in some deals was that I had forgotten to calculate out of like the total costs was myself.
Yeah,
Like when
right.
you, yeah, so you're looking at the purchase price of rehab, how much it's going to cost to close, those commissions, and then you see this nice, chunk. Let's just say like it's 100,000, but you're like, wait, hold on, 100,000 is the gross profit. It doesn't calculate like my expenses, my time, my all that,
Mm-hmm.
and holding and all this sort of stuff. So then I realized that a deal shouldn't even be something, which I then figured out what my fixed costs are with like overhead and holding and all that. And I came up with like it's 15,000 a month minimum. So if a deal is going to be, 4 months as an example, then I need to not only do the ARV minus rehab, minus commissions, but minus 60,000, so that I could, and then what's left over is the profit. And if that didn't accommodate me, well, then what's the point? So, uh,
I need to shout the out right now to everyone. All 122 people, well, 121 besides the like, she gets it. This is what Profit First is supposed to do. It's supposed to make you think differently about your money. Like this, I wish I would have set this up. It was almost the perfect setup. So I'm so grateful for you, but this is so great because you're not just telling me about a deal you did. You told me that habits changed and the way you're thinking about the deal has changed. That's what Profit First is really about. It's not some glorified system to be like, oh, let's do an accounting hack, or like, let's set up some bank accounts. Won't that be cool? It's more about you as an owner making sure you're protecting yourself. Like, if you're doing these deals and you're scaling up, you don't want to scale yourself out of business just because you do a deal and it makes 100K. It's like, okay, but how many of those are you doing at a time? And like, is there enough cash to do these deals? Are you paying yourself? Like, just because you're doing lots of deals doesn't mean that you're actually a healthy business, which I can attest to that back in the day. And that's why I'm preaching this so hard, why we teach this stuff. So Thea, thank you so much. And I really appreciate what you said at the end, just how it made you think differently and for actually doing something with it. You read it, you implemented, you did something about it. And that's where I want you to build this habit, because the more deals you do, the better you become at analyzing it to know, like, what should I really do here? What will this end my cash balances at? Like, do I have enough to do this deal? And then to be able to have fun with it. I saw you put some towards profit. I'm like, I love this. Like, have some fun with that profit account. So it's like, we just ended a quarter, like, take some of the profit and have fun with it. Do what you want with it. So thank you, Thea. Really appreciate you asking those questions. Cool. This was great. Any other questions that you see, Eric? Maybe in the chat. I don't know if the chat's updating for me or Q&A. Cool. We might be done. I don't see anything else. Do you see anything, Eric?
I'm scrolling, and the
Do we have
questions
any?
I see, Bailey's done a pretty good job at responding. I'm looking for some that may not have been asked. I'm across one now. What are some traditional cost codes to use? Examples: advertising, revenue, interest, expense, that you typically see. Are you talking about the chart of accounts where they have the number codes in front? I may not be the best person to answer that question. I see some chart of accounts that have it, and if they have it, we use it, and if they don't, we don't.
We used to have one, and just because I'm like if you want something, I'll just get it for you. We used to have one. Org chart. Nope, that's an org chart. I don't need to share that. Let's go to this chart of accounts. I want to see if we have that. We used to have one for the real estate investing, QBO based. Just want to make sure too and look through this. This is an example one that we have for QBO for profit first. Like the disclaimer at the beginning, like this is something that we have where if you want to try and upload it, great, just look at some of these ones to see if this makes sense for your business. I'll share it, but with the disclaimer. So here we go. Anyone with the link? Oh, dang it, I can't share it. I'll put it in the chat in Slack, and then someone else can post it for me. That's an example part of accounts. So if you stayed with us all the way till this, you're the only ones that are getting this one. So there you go. So there's a QBO based chart of accounts. If you can put that in the chat as well, Eric.
Yes.
Good. Don't worry about that pfrei.net. That one's super old. It's simplecfo.com. I don't even think that one's active.
David, I'll make sure these get posted in the course too. Yep.
Yeah, no, that would be great because, like I said, disclaimer, we haven't updated this for a while, but this is a good starting point if you have no idea where to start with the chart of accounts, and especially like for profit first and what we're teaching here. So cool.
Boom.
Okay. Any other questions that you saw, Eric? Because yeah, I didn't see that one.
There was another one that I saw. Let me see if I can find it again. As your real revenue increases, why in this model are you not recommending that your advertising also increases? Well, let's look at that.
Do you mind if I answer this one? Because this one I built with HomeVestors a few years ago specifically. And you want to get a 5x return, obviously, when you're getting bigger, but then your team's going to get bigger too. And you got to think about it. If you're making 10 million and you're spending 20%, you're spending $2 million on advertising a year. You're spending almost, like what, 160K a month, that you're spending at that level. So as you grow in scale, there's also going to be the economies of scale, like where you'll get a diminished return the more you pump into it. So it's like once you get bigger, the more you're spending doesn't necessarily mean the more is coming in at that level. Now, a lot of people are in columns A, B, and C, and that is when you need to be spending the most, like to get the return right now, because you'll get more leads the more you pump into it. But as it gets bigger too, you're investing in like leadership teams, and like there's several Home Investors franchisees that have like different areas that they're over as well too. So it's like you might have teams as well. So it's like you need to make sure that you're having a baseline of at least X percentage, 20% at the highest levels, because you're spending lots and lots of money to get the deals in the door, but you're making sure also you're covering the overhead and the team. Because a lot of people ask, why does the owner's pay go to zero? I get that question a lot when I'm out as well too. Why does owner's pay go from 50% to zero? If you're making 10 to 50 million, you probably have hired a CEO even to handle your business at that point. So you'd be taking 20% of profits on a quarterly basis, see in column F, and that's what you're living on. If you're doing 20% just of 10 million, you could probably live off of 2 million a year at that point. If you're taking, $500,000 a quarter out, and able to actually put that in the bank and do something with it. So if you're making 50 million, it's a whole lot more. So that's where at that level, it's more towards you've got a full team. You're more in the owner's box, like even above the CEO and stuff, and like of your company. So that way you're more of a board of advisors. So that's why that, and making sure that you're not overspending at the higher levels too. And that's why OpEx is, if you need to put more towards advertising, those are the minimums we suggest. But OpEx, like Eric said, you can lump those together. If you don't need as big of a team, maybe you're doing something that's less people intensive. Maybe you're doing more wholesaling versus flipping. That's more obviously contractors, staff, team, project managers, or property management if you're on the rental side. We've seen wholesale, if you just do wholesale, not that I'm endorsing just wholesale, but if you do that, we've seen margins be a lot bigger for wholesalers because you don't need as many people because you're wholesaling the contracts and assigning the contracts versus doing a whole big project. I do want to share one thing. If you're just flipping right now, that's great. But I would also say always have in your back pocket a short-term strategy to get cash in the door, like wholesaling or wholetailing, or I don't know, like even on the even short-term rental type income, if you're already on the rental side, like something that can get cash in the door quicker. So that way you have long-term strategies, but when those stall out, like in a slower market, like if it becomes more a buyer's market, like it is now in Florida, more of a buyer's market than a seller's market, it's like you want to be able to cover your cash during those slower times as well. So it's like making sure you have the short term. So that way, when if a lead comes in, you've got a couple different options for them. What is that saying? Everything looks like a nail to a hammer. Like it's making sure that you have different tools in your tool belt for the right things as well, like wholesale or flip. Short term, because I need cash, I need ATM money, but the flips, being able to get those bigger chunks and move the business forward as well. Cool. Is there any others, Eric? Because the chat, I don't think the chat's up.
Yes, I'm looking at one right now from Ashley Vance. The question is, how often are most owners paying themselves? Per deal or regular distribution payments, weekly, monthly, quarterly, question mark? I'll give it a first stab, and if you have something to add, David, it's more than welcome. So from what I see with the clients I work with, if you have a decent flow of deals that are closing on a regular basis, Profit First, the book mainly, they recommend the 10th and the 25th as allocation days, but you could also do allocations on a weekly basis if you wanted to. And so for clients that I have that have a decent deal flow that in constant closings will either go to something weekly or 2 days a month that kind of syncs with their payroll. The main thing is that you get a rhythm and you stick to it. That one thing, it may sound like a small thing, but it's really big in terms of being able to notice patterns in your finances. Now, if you are a fix and flipper and the deals aren't coming in fast, then in those cases, we'll do an allocation when the deal closes. So it depends on the quantity of deals that you're doing, and making sure that I'll recommend an early allocation if OpEx needs some money and there's money in the income account. So that way you don't have to borrow from a different account to use accounts against the reasons that it's needed. So short answer is a lot of deals or decent deal flow, either twice a month or once a week, depending on what works best for you. If you have more sparse deals, do it per deal.